The amount of cash that is currently being stashed away on the sidelines has just hit $7.2 trillion. This is the amount of money that is currently being stored in money market funds, which is where institutional investors store their cash. We've seen it jump by $2 trillion within just the last 2 years. For comparison, it took 20 years for the amount of cash in money market funds to jump by $2 trillion between 1981 and 2001. There is a massive shift happening in the financial system right now. Investors have been rushing towards cash at a record pace. This kind of a rush towards cash is not reflective of a healthy, vibrant economy, and it may be a symptom of something more worrying happening underneath the surface. We're going to look at exactly what that is in this video and what we should do about it as traders. The last 3 times we saw such a surge in the amount of cash stored in money market funds was in the late 1990s, in 2006-2007, and 2019. Each of these significant jumps in money market fund assets was followed by some kind of big, unexpected economic shock, whether that is the dot-com bust in 2000, the housing bust in 2008, or COVID in 2020. That begs to ask the question whether history is about to repeat this time around. Before we dive into this, make sure not to miss the massive discount that we're doing at Bravos Research. You'll have access to our entire trading strategy and all of the market updates that we provide to our clients throughout the week. We locked in some incredible profits over the last couple of months, including a 50% gain on our trade on BYD, on NRG, and on our multiple trades on gold. The discount that we're doing won't last long, so make sure to click the link down below to not miss it. So why are investors hoarding so much cash in money market funds today, and is it foreshadowing something bad to come? Now, most people think that this is happening because investors are somehow aware of an underlying economic crisis and are accumulating cash in preparation of that crisis unfolding. But the reality is a little bit different. It's actually because investors are fleeing towards cash that you eventually get an economic crisis. You see, investors allocate capital towards various different assets depending on the return on investment that they can expect from each particular asset. If investors are allocating a lot of their capital towards cash, it means that cash is providing an attractive return on investment relative to other assets. Or in other words, that interest rates on cash are high enough for investors to divert capital away from other investments and instead just accumulate cash. So that means less capital allocated to things like research and development, infrastructure projects, the expansion of business operations, and hiring new workers. It also means that individual consumers will be less likely to spend and more likely to save up money at the bank to earn the higher interest rates. This very simple mechanism can completely suffocate the economy. This is why the interest rate on cash, which is controlled by the Federal Reserve, have such a massive impact on economic growth, because depending on how high they are, they will influence how much capital is taken away from things that can stimulate economic growth. And that is precisely the situation that we're currently in, as a record amount of capital is flowing directly into money market funds instead of going into other areas of the economy that could support economic growth. And we have been seeing actual symptoms of this. Take the index of leading economic indicators, for instance. Since 2021, this index has been in free fall. This was the exact moment where interest rates on cash rose rapidly from 0% to 5%. And as you can see, that has been suffocating the economy. This is an index that includes data like consumer goods orders, manufacturing orders, building permits for housing, the average number of hours worked in a week in the manufacturing sector, and a bunch of other metrics that track the strength of the economy. And on average, ever since interest rates have climbed, we've seen all of these metrics declining significantly. Now, when we look at history, typically these leading economic indicators track the performance of the US stock market pretty accurately. This time, though, we've seen a huge divergence build between the leading economic indicators that are reflecting weakness and the stock market that's been surging higher. This is something that we've been talking about for quite some time, the fact that we're seeing a complete divergence between the financial and the real economy. Yes, the S&P 500 has been performing very well over the course of the last 4 years, but when you look at the performance of small capitalization companies in the United States over the last 4 years, they've been overall going down. The US small cap index has declined by 13% since its peak in 2021, which again coincided perfectly with the moment where interest rates on cash began to rise. As the saying goes, small businesses are the backbone of the economy. They represent 43% of overall GDP. They're responsible for about half of the jobs that exist in the economy. And the reality is that this backbone of the economy right now isn't very strong. Now, it hasn't fully broken, but it's definitely been struggling. Now, you're probably wondering, are we going to end up seeing it actually break anytime soon? A complete breaking of the economy would mean that we experience a recession, which would mean that the unemployment rate in the United States rises. If we look at the unemployment rate, it has been rising over the last year or so, reflecting the economic weakness that we are seeing underneath the surface. But the rise hasn't been so aggressive that we can really categorize this as a full-blown recession like we could for COVID, 2008, or 2001, that were all officially classified as recessions by the NBER. And there is a reason for this. There's something that has been keeping the economy from completely cracking. This is one of the most influential financial variables of the last 150 years. It is uncontrollable, can be extremely volatile, and it's something that most economists completely underestimate the impact of. If you haven't guessed it yet, it's simply the price of a barrel of oil. Because if we add oil prices on top of the unemployment rate, and we shift it forward by a year and a half, you'll notice that the two lines click together almost perfectly. That is because when oil prices rise, a development that is often completely uncontrollable and often unexpected, it immediately puts downwards pressure on economic growth and is one of the only economic variables that can really trigger a recession all by itself. Every single rise in the unemployment rate going back to the 1980s has been preceded by a rise in oil prices. In 2022, we also had an oil shock, but the economy was able to avoid a recession. Ever since then, however, oil prices have been steadily declining, and we think this is one of the big reasons for why the economy has been able to avoid a recession all this time. And this is why we believe, although the real economy is struggling, it could very much continue to hold up. But if oil prices were to rise in a substantial way from here, that would certainly deal a lot of damage to the economy and push it into a recession very quickly. We're watching this very closely at bravosresearch.com. Don't forget to take advantage of the massive discount that we're doing on our website right now. There's not much time left. Thank you for watching.